I think if you pay attention to $100 trillion in off-balance sheet obligations, you come to the conclusion that the only way out of that trap is reducing the spending power of the US dollar. If you do that, like in the 1970s, when you reduce the purchasing power of the medium of exchange by 75%, the other thing that happened in the 1970s is that the price of gold went from an admittedly price controlled $35 to $850. I'm not saying that past is prologue. What I am saying is that people who perceive the problem might consider insuring themselves with the store of value that worked last time.
Recent developments in global financial markets have led to renewed interest in gold as a safe haven asset. Despite its record high prices, many investors are still waiting for a more significant price movement, especially given gold's long-term stability over the past 2 decades. However, as concerns about inflation, economic instability, and growing government debt continue to rise, the conversation around gold's role in preserving wealth is becoming more prominent. RickRule, a renowned expert in the precious metals industry, has been outspoken about the potential for gold to play a pivotal role in the years ahead. He explains that despite its relatively steady performance, gold remains an undervalued asset in the eyes of many. Rick draws parallels to the 1970s, when gold's price surged in response to inflation and a weakened US dollar, suggesting that we may be on the verge of a similar scenario. As the global economy grapples with mounting fiscal challenges, gold could experience another significant price increase, making it an essential component of any investment strategy. Rick also addresses the issue of gold price manipulation, noting how financial institutions and central banks use instruments like futures contracts to keep prices artificially low. He emphasizes that these tactics distort the true value of gold, preventing it from reaching its potential. As awareness grows about these manipulation practices, Rick predicts that more investors will turn to physical gold as a hedge against inflation, which could lead to a substantial price correction in the market. With increasing recognition of the risks associated with fiat currencies and economic instability, Rick sees gold as a critical asset for preserving wealth in the years to come. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
A gut feeling that next year will be a little less generous. So I'm doing a couple things. I'm where the market has been too generous to me, I'm taking some money off the table. I'm doing some selling. Where I've made mistakes, I'm selling ruthlessly to book the tax loss so that I get to keep some of the money that I made in decisions that were good to me. I would say on a risk versus reward basis that the best place to be is probably in the gold trade. It's unusual, from my point of view, to find high quality gold companies, irrespective of market cap, that is to say, the best of the best or the best of the juniors, priced reasonably. And I see them being priced reasonably. I'm not trying to say that the biggest gains that you can harvest will be in the gold sector, but if you juxtapose risk to reward, and if you look at the valuations of the good companies in the sector relative to their historic norms, when I say price versus value, I'm really talking about enterprise value versus net present value. That sector seems attractive to me. The sector, too, has, pardon the pun, but lost its luster. The US dollar has been quite strong post-Trump's election, and there seems to be euphoria in the United States that the Department of Government Efficiency, led by a person who became a billionaire on subsidies, is going to do some spectacular job reducing the size of the US government. I think that's utter fiction. I don't think that we'll run out of that perception anytime soon, which is to say, I don't think that you're going to see a panic into gold anytime soon of the maintenance of purchasing power in the US dollar is going to continue is silly. I think the dollar will do well compared to other basket case currencies, your own included. I think the dollar will do well against the euro. I think it'll do well against the Swiss franc. I do think it'll do well against the British pound, the Canadian dollar, the Australian dollar, all of that. I don't think that we will maintain purchasing power in the US dollar.
RickRule emphasizes the severe challenges the U.S. economy currently faces due to its growing debt and unfunded liabilities. He points out that much of the government's financial obligations, totaling over $100 trillion in unfunded entitlements, are not included in official debt ceiling discussions, which he views as a significant omission. While the debt ceiling debates focus on the $36 trillion owed to bondholders, Rule highlights that the true financial burden of unfunded liabilities is largely ignored. This growing debt, combined with the looming obligation to pay entitlements, will eventually impact taxpayers, particularly future generations, who will bear the brunt of this unsustainable fiscal policy. RickRule predicts that the U.S. government will likely resort to devaluing the dollar to manage its obligations, similar to the inflationary strategies seen in the 1970s. By reducing the real value of these obligations, the government can avoid outright defaults, but at the cost of diminishing the purchasing power of the dollar. This approach would severely impact those relying on government benefits, particularly the elderly, making previously promised entitlements far less valuable. While RickRule remains optimistic about American innovation and entrepreneurship helping to mitigate some of these challenges, he acknowledges that the country faces an inevitable reckoning with its debt, which will have profound economic consequences for future generations.
What you learn is that when you achieve beta over the course of a market cycle, the beta in the gold space is huge. You don't get gold bull markets often, but when you do, the rewards in a concentrated period of time are superb. Ironically, when the gold price does well, it benefits the marginal companies more than it benefits the great companies. What I've learned is if I can expect 250 or 300% beta over 3 or 4 years in a gold bull market, but I don't know when that gold bull market's going to start, I'm better off giving up a little bit of my beta by de-risking my portfolio in an operational sense. In other words, rather than experiencing 325% over 4 years, I experience 275%, but I remove 75 or 80% of the operational risk by doing so. You follow where I'm going? If the beta that I'm looking at is so gigantic, which in the course of my 50 years in the business it has been, the idea that I underperform the market a little bit by taking away most of the risk seems to me to be a very good trade. And I also want to say, and I will give you a couple names, you don't have to be in the Francos and the Agnicos if you're willing to do the work. There are some extremely high quality juniors. I'm thinking about names like Entree Resources, where Rio Tinto's coming right at them, underground at Oyo Tolgoi. Origin Resources, where you have a royalty on the silica cap deposit. Kennerland Resources, one of the best practitioners of prospect generation model, headed by somebody your generation as opposed to my generation. There are some very high quality juniors. There are other juniors that, if you can take the risk, control tier 1 deposits in out of favor sectors. These are companies that expose you over 5 years to legitimate 10-to-1 returns. So sovereign resources would probably be an example of that. Meteoric resources would probably be an example of that. You need to be willing to take absolute risk, and you need to understand that most legitimate 10-baggers require 5 years. That's what the requirement is. Most legitimate junior 10-baggers experience 15 or 20% volatility the same way that you and I experience breakfast, lunch, and dinner, the same way that we breathe. They aren't indicative of anything. But investors who don't understand the thesis, who don't understand the basics, get freaked out by a 15% share price decline, or they get elated by a 20% share price increase, when both of them are irrelevant. To the extent that your audience cares about the juniors, and clearly they do, they need to understand how the industry works. I'm not saying to avoid them. I'm saying that the number of juniors in your portfolio should correspond with the number of hours per month that you're willing to spend studying them.
Gold is expected to remain a strong, safe haven asset in the coming years, with several major financial institutions offering similar outlooks. Analysts at J.P. Morgan predict that gold will continue to see strong demand from institutional investors seeking to hedge against inflation and geopolitical risks, while Citi forecasts increased appeal as economic uncertainty rises and central banks maintain monetary easing. Goldman Sachs anticipates that gold could reach new highs amid ongoing fears of inflation and financial instability, and BMO Capital Markets expects the metal to benefit from rising debt levels and loose monetary policies. UBS similarly believes gold will thrive as a defensive investment during periods of economic turbulence and low real interest rates. Please share your thoughts in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.